So usually when we talk about like a medical diagnosis, there's this comforting expectation of precision, right?
Oh yeah, for sure. You want certainty.
Exactly. I mean, if you break your arm, the x-ray just shows this jagged white line on a black background, and the doctor just points to it and says, there it is.
Right. It's completely binary. It's clean. It's either broken or it's not broken.
Yeah, and it's totally visible because we're wired to prefer problems that you can neatly categorize and just see right away.
Human nature. We love a clear picture.
But, when you step out of the clinic and into the world of corporate finance specifically, like the world of these massive medical technology turnarounds, that pristine x-ray machine just completely breaks down.
It really does. It gets so messy.
Right. We're looking at a diagnostic landscape for these companies that is, frankly, murky. It's contradictory, and it is heavily layered with financial engineering.
Oh, heavily layered. That is the perfect way to put it.
So today on Talk Tickers, we are pointing our diagnostic equipment at Baxter International, ticker symbol BAX.
A giant in the space.
Yeah, and we're dissecting their Q2 2026 earnings call along with the accompanying SEC filings. Now, the mission for Talk Tickers today, as always, is stripping the Wall Street jargon out of these documents so you, the retail investor, know exactly what is happening with your capital.
And honestly, Baxter is just a perfect candidate for this kind of rigorous analysis right now.
Totally.
Because, if you have ever been in a hospital, you have interacted with Baxter. They are a colossal global medical tech and equipment company. But right now, sitting here in the middle of 2026, they're deep in the trenches of an incredibly complex strategic turnaround.
Yeah, and I actually want to spend a second on that context.
Yeah.
Because looking at a single quarter's numbers without understanding, like the last 3 years for Baxter, it's like trying to read a book starting on chapter 20.
You're going to be completely lost.
Right. So when we talk about Baxter's turnaround, we are looking at a company trying to dig out from underneath this absolute mountain of structural issues.
It's a huge mountain.
It really is. They took on an enormous amount of debt a few years ago when they acquired Hillrom, which, drastically changed their leverage profile exactly when global interest rates started to spike.
Yeah, which is just the worst possible timing. That's the macro narrative here. They are fighting a multi-front war.
Break that down a bit. What are the fronts?
So first, they are aggressively trying to stabilize a supply chain that just completely fractured during that post-pandemic inflationary spike.
Right, the supply chain nightmare.
Exactly. And second, they're working furiously to trim down that massive Hillrom debt load, before the interest expenses completely choke out their cash flow.
Which is a real risk.
A huge risk. And then third, they are attempting to prove to the market that they can still innovate, right?
Yeah.
Like they need to launch next generation products into a hospital ecosystem that is just hyper competitive right now.
So we've got our sources, the Q2 transcript, the management commentary, the analyst Q&A, and we've got our mission. We're going to hit the headline numbers, break down the actual operational story driving those numbers, and then we'll scrutinize management's promises for the rest of 2026.
And ultimately deliver that bottom line actionable verdict.
Exactly.
Yeah.
Is this turnaround a value trap or is it a genuine opportunity for you? So I pulled the Q2 release this morning and I got to say, the divergence in the top and bottom lines is the very first thing that jumps off the page.
It is stark. It really makes you do a double take. Let's hear the numbers.
Okay, so for the second quarter of 2026, Baxter's global sales hit approximately $3 billion. That represents a 5% increase on both a reported basis and an organic basis.
And we should probably clarify those terms real quick for anyone new to earnings report.
Yeah, please do.
So reported growth is just the raw number, right? It factors in absolutely everything, including currency exchange rates.
The messy number.
Right. But organic growth strips out the impact of foreign currency fluctuations and also any recent acquisitions or divestitures. So it basically tells you how the core underlying business actually performed. And seeing a 5% bump on both metrics is honestly a generally solid signal for a company of this sheer size.
Yeah, generating $3 billion in a single quarter is just a massive logistical undertaking. And a 5% increase shows that end market demand is, at the very least, pretty stable.
Very stable. People are still buying their stuff.
Right. But the bottom line tells a completely different story.
This is where it gets weird.
Yeah. So adjusted earnings per share, or EPS, came in at 56 cents. And that 56 cents is actually a 5% decrease from the prior year.
Ouch.
Yeah. Sales are going up,
Yeah.
but the actual profit trickling down to each share of the company is shrinking. And yet, if you look at the reaction, Wall Street essentially cheered this report.
Because it beat their internal consensus model.
Exactly. Which leads me to this massive $75 million anomaly that's just buried in that 56 cents of earnings.
Yes. The IEPA tariff refund.
Yes, the infamous tariff refund. When you read the management commentary, CEO Andrew Hyder says, quote, "Results reflect a tariff refund that was not contemplated in our original guidance."
Which is corporate speak for, we got lucky.
Seriously. And later in the call, the interim CFO, Anita Zielinski, specifies that this refund provided an 11-cent per diluted share benefit to the quarter.
That's a huge chunk of the 56 cents.
Right. So to put this in plain English for you, Baxter basically received a $75 million check from the government, probably tied to like state environmental or import tariffs regarding their factories that they successfully appealed or got refunded.
It was just a complete windfall.
Which brings me to my question for you. If you are an investor looking at the health of this company, is claiming this 56-cent earnings beat essentially like, okay, imagine finding a $20 bill in a winter coat you haven't worn in a year.
Okay, I'm with you.
And then taking that $20, proudly walking up to your family and telling them you got a raise at your job.
That is honestly a highly accurate way to frame it.
Right. It just feels a bit deceptive.
Because the $75 million refund was a completely unexpected one-time benefit. It had absolutely nothing to do with Baxter selling more IV bags or, optimizing their factory lines or moving more surgical equipment in Q2.
It's just past money.
Exactly.
Right.
It was previously paid out in tariffs, and now it's returning to the balance sheet. So when you see that 11-cent boost to the EPS, you must mentally isolate it.
You have to strip it out.
Yeah, if you're modeling the actual operating health of the business, you cannot count on finding $20 bills in your coat every 3 months.
Right. Because if we pull that 11 cents out of the 56 cents, they are actually operating at 45 cents a share.
Which is a much lower baseline.
Yeah, which makes that 5% year-over-year EPS decrease look significantly worse.
Mm-hmm.
The underlying profitability is actually contracting way faster than the headline suggests.
It definitely makes the optics worse, I'll give you that.
Yeah.
But we do have to contextualize this against management's internal projection.
Okay, how so?
Well, Baxter has been remarkably transparent for the last 3 quarters that the first half of 2026 was going to be painful.
They did warn everybody.
They did. They had, in their own words, known mechanical headwinds that they fully expected to drag down their margins early in the year.
Right.
So their internal models and the guidance they actually issued to Wall Street predicted an even steeper drop in EPS.
Ah, I see.
The CEO specifically noted that even absent this 11-cent benefit, their underlying operating margins still exceeded their internal, albeit pessimistic, expectations.
So it's a low bar, but they cleared it.
Exactly. They're essentially communicating that, yes, the bottom line is shrinking as they clean up historical messes, but it isn't shrinking quite as violently as they initially modeled.
Okay, I see the logic there, but as a retail investor, I can't just accept the premise that things are like less bad than the worst case scenario.
Fair enough.
We really need to look at the mechanics of the business. If we mentally set aside that lucky tariff money, what actually drove that 5% top-line sales growth?
Sure.
We need to look at the winners in the quarter to understand where this $3 billion even came from.
Well, the biggest structural shift to examine here is their newly organized reporting division.
The ITP thing.
Yeah. Earlier this year, Baxter combined their pharmaceuticals business and their infusion therapies and technologies business under a single leadership umbrella. And they now call this combined unit Infusion Therapies and Platforms, or ITP.
Now, changing reporting segments is like a classic corporate move, right? And it often frustrates analysts because it breaks all the historical comparisons. So why combine these two massive divisions right now?
Management's rationale is that it supports stronger coordination because these businesses actually share common customers and common clinical workflows in the hospital pharmacy space.
Meaning they're basically selling to the same people anyway.
Exactly. An infusion pump and the pharmaceutical fluid running through that pump are part of the exact same clinical ecosystem. So from a reporting standpoint, this new ITP division was a clear winner in Q2.
What are the numbers?
They generated $1.7 billion in revenue, which translates to a pretty solid 4% organic increase.
Okay, so diving into that $1.7 billion, I noticed that IV Solutions saw growth, but management attached this massive caveat to it.
The new baseline.
Yes, they stated this growth is coming off a, quote, new lower baseline of demand due to clinical practice changes. What exactly does a new lower baseline mean in the context of IV fluids? Like, are people just less dehydrated now?
No, it's actually a fascinating shift in hospital protocols.
Really? How so?
Well, later in the Q&A session, an analyst from Evercore asked if there was some massive restocking event that artificially drove this IV fluid growth, and the CEO was emphatic that there was no massive restocking. He basically stated, this is the new norm. This is the baseline. Because over the past few years, and particularly accelerating post-COVID, hospitals have fundamentally altered how they utilize IV fluids.
Interesting. What are they doing differently?
They've become way more focused on fluid stewardship. So maybe they're shifting patients to oral hydration faster or tightening their protocols to avoid, fluid overload in certain vulnerable patients.
Oh, wow. That makes perfect sense clinically.
Yeah.
But financially, that means Baxter is selling into a structurally smaller market pie.
Yes, exactly.
I mean, they're growing, but they're growing off a diminished foundation.
Precisely. They have had to completely recalibrate their manufacturing and sales expectations to match this new clinical reality. But, the more compelling growth story inside this ITP division is the second driver,
Which is?
Drug compounding. The CFO noted that demand for their drug compounding services surged by double digits.
Double-digit growth is a massive outlier in a mature medical device company.
Huge outlier.
Let's define the mechanics of drug compounding for anyone who might be unfamiliar with the pharmacy space, because it's super crucial to understanding Baxter's current margin issues later on.
Yeah, it's vital context. So in a traditional hospital setting, drug compounding is just the process of combining, mixing, or altering ingredients to create a specific medication tailored to an individual patient's needs.
Right. Like a bespoke medication.
Exactly. And historically, a hospital pharmacist would do this manually in a back room, measuring fluids, injecting them into bags, ensuring sterility, all that.
Sounds tedious.
It is highly labor-intensive, time-consuming, and unfortunately, it's prone to human error or contamination.
Okay, so companies like Baxter step in and industrialize that whole process.
Exactly. They provide outsourced compounding services. So they deliver ready-to-use, pre-mixed, heavily regulated medications in exact dosages straight to the hospital loading dock.
Which is huge for the hospitals.
It's a game changer. It saves the hospital immense amounts of pharmacy labor, it drastically reduces the risk of dosing errors, and it shifts the entire burden of maintaining these expensive, sterile clean rooms onto Baxter.
And considering the ongoing nursing and pharmacist shortages in the healthcare system right now, it is entirely logical why hospitals are outsourcing this at a double-digit growth rate.
Absolutely. It solves a major pain point for them.
Okay, so ITP is growing steadily, driven by this outsourced compounding. But looking at the segment data, the absolute star of the quarter from a growth percentage standpoint was the advanced surgery division.
Advanced surgery was a standout. Sales in that division totaled $331 million, representing a 12% growth rate.
Wow, 12%.
Yeah, and management credited this to strong, sustained demand for their global portfolio of hemostats and sealants.
For context for you listening, hemostats and sealants are essentially high-tech biological glues and clotting agents. Surgeons use them to control bleeding during complex procedures where, traditional suturing just isn't viable.
Correct. And the demand for these products is directly tied to global surgical procedure volumes.
Right, because during the pandemic, elective surgeries plummeted, which completely crushed this division.
Exactly. And now we're seeing a stabilization and even a slight backlog clearing effect in global procedure volumes.
So hospitals are playing catch up.
Yeah. So as surgical operating rooms run at full capacity, the burn rate for these sealants just accelerates, and that's what's driving that 12% growth.
Okay, so we have a very clear picture of the top line now. 40 fluids are growing off a new baseline, hospitals are outsourcing their compounding at a massive rate to save labor, and surgical volumes are driving sealant sales.
It's a solid foundation.
It really paints a picture of a healthy, in-demand product portfolio driving that 5% revenue bump. But this is where we have to translate the accounting jargon and figure out why a healthy top line resulted in a 5% EPS drop.
The dreaded margin compression.
Right. Management blamed a 350 basis point drop in their medical products and therapies operating margin. Now, before we analyze why, let's just establish that 350 basis points means a 3.5% contraction in profit margin, which is a severe squeeze in manufacturing.
It is a painful contraction. You don't want to see that. And when explaining this 3.5% drop, the CFO cited, quote, higher manufacturing costs, including lower absorption.
Lower absorption.
Yeah. And throughout the transcript, they repeatedly reference the, quote, roll-through of higher-cost inventory produced at the end of 2025. This is really the core mechanical headwind dragging down the company.
Okay, lower absorption and the roll-through of higher-cost inventory. I mean, this is prime Wall Street jargon that completely obscures the actual factory floor reality.
It definitely hides the ball.
Let's break down the mechanics of absorption accounting for the listener, because it's fascinating.
It requires looking back at the macro environment at the end of 2025. Baxter, like pretty much every global manufacturer, was dealing with intense supply chain chaos, soaring raw material inflation, and unpredictable factory scheduling.
It was a mess.
So let's use a simplified hypothetical here. In a normal, optimized year, it might cost Baxter $10 in raw materials, labor, and factory overhead to manufacture a specific medical widget.
Okay, $10 to make a widget. But 2025 was not normal.
Far from it. Because raw materials were scarce and expensive, and because their factories weren't running at full capacity, meaning they were producing fewer widgets overall, the fixed overhead costs of the factory, like rent, electricity, and machinery depreciation, had to be spread out or absorbed across a much smaller number of widgets.
So that's what lower absorption means.
Exactly. You're absorbing the same fixed costs over fewer products. So instead of costing $10, that exact same widget cost them, say, $15 to manufacture in late 2025.
Which totally makes sense as a historical problem. But why is a manufacturing inefficiency from November of 2025 suddenly destroying their profit margins in the second quarter of 2026? Like, why the delay?
This is entirely due to how inventory accounting dictates the flow of money from the balance sheet over to the income statement.
Okay, walk me through that.
So when Baxter manufactures a product, the cost to make it does not immediately register as an expense on their quarterly earnings.
Wait, really?
Really, instead, that $15 cost sits quietly on their balance sheet, categorized as an asset, specifically inventory.
Interesting.
Yeah, it remains tracked on the balance sheet, completely isolated from their profit margins until the exact moment that specific widget is actually sold to a hospital.
So Baxter spent the inflated $15 to build the widget in late 2025. It literally sat in a climate-controlled warehouse for, 6 months?
Yep, just sitting there.
And then finally, in April or May of 2026, a hospital ordered it.
Exactly. And the moment that sale is recognized, the accounting rules require that inflated $15 cost to migrate from the balance sheet over to the income statement, registering as cost of goods sold or COGS.
Wow. Okay, I get it now.
Yeah, so even though Baxter is generating strong sales volume today, the gross profit they're capturing on each of those older items is severely compressed because they were just so agonizingly expensive to manufacture 6 months ago.
And that delayed financial impact is the roll-through of higher cost inventory.
You nailed it.
It's essentially a financial ghost from the supply chain crisis of 2025 just coming back to haunt their current operating margins. I mean, the business isn't fundamentally failing to sell products today. They're just paying the piper for the factory inefficiencies of yesterday.
That is the absolute perfect way to contextualize it. It's a ghost. And this delayed reaction was a known factor.
They saw it coming.
Oh, absolutely. Management warned analysts months ago that this expensive inventory was sitting on the balance sheet and would have to be flushed through the system in the first half of 2026.
So it wasn't a surprise.
No, which is why their tone on the call was almost relieved when they stated that this specific batch of high-cost inventory has now fully cleared the pipeline.
Okay, so the inventory ghost is one half of the profitability problem. But looking deeper into the Q&A session, there was a second structural issue dragging down the margins, and it relates directly to the product mix.
Yes. The mix issue. It's a fascinating double-edged sword for them.
Why is that?
Well, earlier, we highlighted the massive double-digit growth in the drug compounding business as a major victory for the top line, right?
Yeah, it sounds like an incredible win. I mean, any division growing double digits is usually celebrated on an earnings call.
And from a pure revenue generation standpoint, it is a win. However, structurally, drug compounding is an inherently lower margin business compared to, say, Baxter's advanced surgery products or their capital equipment.
Wait, why is it lower margin? Is it the raw materials they're buying?
It's a combination of intensive labor and hyper-strict logistics. Operating a compounding facility requires specialized, highly paid pharmacists, massive cleanroom infrastructure, rigorous sterilization protocol.
Right, you can't cut corners there.
Absolutely not. And often it requires rapid cold chain logistics because these mixed drugs have incredibly short shelf lives. You cannot manufacture them months in advance and leave them in a warehouse.
So the overhead is just immense.
It's massive. So when this lower margin business segment grows aggressively and becomes a much larger percentage of your total sales, it mechanically drags down the average profit margin of the entire company.
Even if the total dollar amount is going up?
Exactly. It just weighs down the average.
It's a classic margin mix dilemma. They are almost like victims of their own success in that specific service line.
Pretty much.
I mean, they are selling a tremendous volume of compounding services, but they are capturing fewer pennies of profit on every dollar sold compared to, a syringe of surgical sealant.
Analyst Travis Steed from Bank of America caught this immediately.
Oh, he called them out.
He did. During the Q&A, he pushed management on how much of the revenue upside was strictly driven by compounding, explicitly noting that the overall gross margin looked really light.
And what did they say?
Well, the investor relations VP, Kevin Moran, conceded the point. He admitted that compounding was a, quote, good chunk of the beat and confirmed its inherently lower margin profile was pressuring the overall corporate mix.
Did management offer a defense for this? Because look, padding top-line revenue with low-margin services is not a sustainable way to execute a financial turnaround, especially when you are burdened with that much debt.
CEO Andrew Hyder stepped in to defend the compounding strategy, and his whole defense rested on cash flow.
Okay, explain that.
He acknowledged the lower margin percentage, but he argued that the compounding business has highly favorable cash conversion.
Cash conversion, meaning the cycle time from, mixing the drug to actually having the hospital's cash deposited in Baxter's bank account is very short.
Exactly. Because these drugs are made to order and used immediately by the hospital, the billing and payment cycle is rapid, and cash is oxygen for a highly leveraged company.
I see.
Yeah, Hyder is essentially arguing that even if the profit percentage is smaller, the speed at which that cash enters the business makes it highly valuable.
That does make sense. Did he mention fixing the margins eventually?
He did. He committed to driving operational efficiencies within the compounding division to slowly lift its margin profile closer to the company average, though he frankly admitted there is a long road ahead to achieve that.
Man, this level of detail is exactly why it is so dangerous to trade on headline numbers alone.
You'll get burned every time.
You really will. I mean, the headline reads, sales up 5%, EPS down 5%. But the operational reality is that sales are up because hospitals are outsourcing low-margin compounding labor to Baxter, while EPS is down because the company is finally digesting the overpriced inventory they built during the chaos of 2025.
It is a profoundly messy transitional quarter.
Transitional is the perfect word, and you really need deep forensic accounting to understand it.
You do. Which naturally leads us to the most critical question for any investor looking forward.
Right.
Now the expensive 2025 inventory is gone and the new baseline of IV demand is established, what exactly is management promising for the remainder of 2026?
Okay, let's look at the guidance, because management actually raised their full-year outlook, which usually sends a stock straight up.
Usually, yes.
They increased full-year organic sales growth projections to a range of 2% to 3%, which is a slight bump from their previous estimates. And more importantly, they raised their full-year adjusted EPS guidance to a range of $1.95 to $2.15.
Now, on the surface, the market loves a beat and raise quarter. But if you apply a critical lens to this specific EPS raise, the optimism starts to look a lot like financial sleight of hand.
Okay, let's do the math on the sandbagging here.
Let's do it.
The old full-year EPS guidance range was $1.85 to $2.05. The new range is $1.95 to $2.15. That is exactly a 10-cent raise to the forecast.
Correct. Exactly 10 cents. Now, recall our earlier discussion about the massive anomaly in this quarter's earnings.
The $75 million tariff refund.
Yeah.
The $20 bill in the winter coat.
Yes. That unexpected tariff refund contributed exactly 11 cents per share to the Q2 results.
Oh, wow. So the one-time non-operational windfall gave them 11 extra cents in the bank today, but they only raised the full-year forecast by 10 cents.
Exactly. The math exposes the reality of their operational confidence right now.
It really does.
They simply took the free unearned tariff money, dropped it into the full-year bucket, and completely refused to raise their underlying operational targets.
That's sneaky.
If you look at it strictly, By absorbing an 11-cent windfall, but only raising the guide by 10 cents, they implicitly lowered their operational expectations for the rest of the year by a penny.
That is incredibly conservative, bordering on deceptive if you just skim the press release. Did the institutional analyst on the call let them get away with that framing?
Oh, they absolutely did not. The analysts zeroed in on this immediately.
Good for them.
Robert Marcus from JP Morgan opened the Q&A by pointing out the one-time tax and tariff items, asking directly if the guidance raise implies softer underlying performance in the second half of the year.
Wow, right out of the gate.
Yeah. And Travis Steed pushed the same issue later, noting that Baxter beat Q2 expectations by 19 cents, total 11 cents from the tariff, plus some favorable tax and interest rate dynamics, yet they only raised the back half by 10 cents.
Just calling out the math.
Right. He asked point blank, is this just being conservative on the second half?
Which is basically analyst diplomacy for, are you sandbagging us because you know Q3 is going to be weak?
Exactly.
How did CEO Andrew Hyder handle being cornered on the math like that?
He handled it with the extreme caution of a CEO executing a very fragile turnaround.
Yeah.
He didn't deny the math. I mean, the VP of Investor Relations had already explicitly admitted that the raise was purely reflective of the 11-cent tariff inclusion.
Right, they couldn't hide from it.
So when pressed on why they weren't raising operational targets, Hyder deployed a very measured tone. He repeatedly stressed that while they were pleased with Q2, a lot of work remains.
Managing expectations.
Exactly. He framed it as just 1 quarter of progress and insisted they're entirely focused on internal execution rather than raising external bars.
I mean, honestly, it's a masterclass in expectation management. Turnarounds are notoriously volatile. If Hyder raises operational guidance today based on a solid Q2, and then, I don't know, a single factory line goes down in Q3 or raw material price spikes.
They miss the new higher guidance and the stock gets punished severely.
Exactly. So by keeping the underlying guidance flat and absorbing the tariff money as a cushion, he gives his operating teams a margin of error.
It is a highly protective strategy. However, we have to acknowledge that even with flat operational guidance, the second half of the year still demands a massive acceleration in profitability compared to the first half.
Right, because they are projecting significant margin expansion to hit that $1.95 to $2.15 target.
They have to hit it.
So if they're playing it safe on the guidance, but they still need a huge jump in profitability to hit their own safe numbers, what is the mechanical basis for that confidence?
Well, interim CFO Anita Zielinski laid out a specific 3-pillar framework for why margins will expand in the second half of 2026.
Let's examine those pillars. What's number 1?
Pillar number 1 is higher volume, which is deeply rooted in the seasonality of the medical device sector.
Right. Hospitals operate on annual capital budgets. So by the third and fourth quarters, departments realize they need to spend their allocated funds, or they just lose them in the next fiscal year.
Exactly. Use it or lose it.
Plus, patients often hit their health insurance deductibles later in the year, which leads to a huge surge in elective surgeries in Q4.
Precisely. And that end-of-year volume surge provides massive leverage on Baxter's fixed manufacturing costs.
Because of absorption.
Exactly. The more widgets you push through the factory in Q4, the cheaper each widget is to produce.
Okay, so volume is pillar 1. What is pillar 2?
Pillar 2 involves the realization of aggressive cost structure actions. In corporate terminology, this just means they are finally seeing the financial benefits of layoffs, facility consolidations, and sweeping reductions in SG&A.
Selling, general, and administrative expenses. The corporate overhead costs.
Yes. Zielinski highlighted that adjusted SG&A actually decreased by 80 basis points, dropping to 21.9% of sales in this quarter.
Okay, that's real progress.
It is. The painful restructuring actions they took earlier in the year are starting to compound, meaning a larger percentage of every sales dollar will actually fall to the bottom line in the second half.
Which brings us to the third and probably most vital pillar for Q3.
The complete evaporation of the expensive 2025 inventory. Zielinski was categorical that the inflated costs tied to the supply chain crisis have fully rolled through the income statement.
So the balance sheet is finally clean.
The historical anchor has been cut. As they move into Q3 and Q4, the cost of goods sold will reflect normalized current-day manufacturing costs.
Okay, so when you combine those 3 elements, seasonal volume spikes, leaner corporate overhead, and normalized factory costs, the spreadsheet logic for margin expansion is undeniable.
The math absolutely works.
The math works. But a spreadsheet is not a factory floor. Executing this requires flawless logistical coordination, which is probably why management spent so much time on the call hyping up their new internal operating system, the Baxter GPS.
Ah, yes. The Baxter Growth and Performance System. The sheer volume of corporate energy being directed at this initiative is staggering.
I have to admit, the CEO noted they've completed over 400, quote, continuous improvement events across the company in the first half of the year alone, with 200 currently active and another 400 planned.
It's a huge undertaking.
I have to push back here, though, because when executive teams start throwing around branded acronyms like GPS and quantifying improvement events, it often sounds like middle management buzzword bingo designed to distract from deeper structural flaws.
I get that.
Like, what does a continuous improvement event actually look like in a real factory?
Skepticism is totally warranted when dealing with corporate jargon, but in a heavy manufacturing context, these events, which are heavily derived from lean manufacturing and Six Sigma principles, they are the granular mechanism of a turnaround.
So it's not just trust falls in a conference room.
No, not at all. Give me a concrete example.
Okay, imagine a cross-functional team of engineers, supply chain logistics experts, and floor managers spending a dedicated week analyzing a single IV fluid packaging line.
Just staring at the line, analyzing every movement. And their sole objective is to find a way to reduce the plastic waste on each bag by, say, 2 grams, or to redesign the physical workflow in a drug compounding facility to shave 3 minutes off the sterilization cycle.
Honestly, 2 grams of plastic or 3 minutes of labor sounds completely immaterial to a $3 billion quarter.
In isolation, it is completely immaterial. But when you apply a 2-gram plastic reduction across 1 billion IV bags produced globally, you suddenly shave millions of dollars off your raw material costs.
Oh, wow.
That is the essence of the Baxter GPS. As CEO Andrew Hyder phrased it on the call, while no single event will define our future, small improvements over time should lead to big improvements.
The aggregation of marginal gains.
Exactly. He is attempting to instill a culture of micro-efficiency. He quoted this mantra: boring consistency, brilliant execution.
Boring consistency, brilliant execution. I mean, it is the absolute antithesis of a flashy tech startup, but it is exactly how you rescue an over-leveraged industrial giant.
It's grunt work, but it pays off.
Which brings us to the most crucial phase of our deep dive today. We have analyzed the tariff anomalies, the compounding margin mix, the inventory absorption, and the conservative guidance. It's time to synthesize all this data into an actionable verdict for the retail investor listening right now.
The diagnostic analysis is complete. It is time for the prognosis.
I am putting you on the spot. Based strictly on the evidence in this Q2 earnings report and the broader macroeconomic context we've established, what is your firm position on Baxter International? Are you bullish, bearish, or something else entirely?
All right. Based on the operational metrics demonstrated in the specific quarter, I am taking a firm, cautiously bullish stance.
Cautiously bullish. Let's unpack the bull case first. Why are you buying into this turnaround?
I am bullish because Q2 was a highly successful show-me quarter.
A show-me quarter.
Yeah. When a company is burdened with massive debt and historical supply chain failures, institutional investors are just paralyzed by skepticism.
They don't believe anything you say.
Right. They demand absolute proof that management can control the variables within their immediate sphere of influence. And in Q2, Baxter actually delivered that proof.
They checked the boxes.
They did. They successfully digested the toxic 2025 inventory, they demonstrably reduced their SG&A overhead, and they navigated a complex hospital purchasing environment to drive organic top-line growth across multiple distinct divisions.
So they proved that despite the macro headwinds, the clinical demand for their core products remains highly resilient.
Exactly. The foundation is stable.
Okay, but where does the caution stem from? Why cautiously bullish?
The caution is rooted in the quality of the earnings. A significant portion of this quarter's EPS beat was fueled by that lucky one-time tariff refund.
The $20 bill.
The $20 bill. Furthermore, the hypergrowth in their compounding division is structurally dilutive to their overall profit margins.
Right, the mix issue.
And most importantly, management's absolute refusal to raise operational guidance for the back half of the year signals that they are acutely aware of lingering fragilities in their supply chain. They are executing the turnaround, but they are walking a tightrope without a safety net right now.
That is a really balanced assessment. But there is one financial metric we haven't deeply explored yet. And in a turnaround defined by a massive looming debt load, it is arguably the only metric that truly matters.
Let's talk about the cash.
Free cash flow. This is the absolute bedrock of the bullish thesis for Baxter. Explain to everyone why free cash flow is the ultimate truth teller in this scenario. Because, as we've seen, earnings per share can be heavily manipulated by accounting rules.
Oh, totally. EPS is subject to depreciation schedules, inventory absorption rules, tax rate assumptions. It can be massaged. But free cash flow is visceral. It is the actual physical cash left in the bank account after the company has paid all its operating expenses, funded its capital expenditures, and kept the lights on.
You can't fake it.
You cannot fake it. In Q2, Baxter generated $181 million in positive free cash flow, bringing their year-to-date total to $257 million.
That is $250 million in pure cash generated in 6 months. So what is the specific capital allocation strategy for that cash? Where is it going?
Interim CFO Anita Zielinski was unequivocal on this. Reducing leverage remains their, quote, top near-term capital allocation priority.
Paying down the debt.
Yes. They are funneling that cash directly into retiring debt. They have a publicly stated hard target. They intend to bring their net leverage down to approximately 3 times by the end of the year.
Okay, let's define net leverage of 3 times for the listener, because hitting that specific ratio is a massive milestone in corporate finance.
Sure. Net leverage is a ratio that compares a company's total debt minus whatever cash they have on hand against their annual earnings before interest, taxes, depreciation, and amortization.
Commonly known as EBITDA.
Exactly. So a ratio of 3x means their total net debt is roughly 3 times their annual cash earnings.
Why is 3x the magic number?
Well, in the current macroeconomic reality, where interest rates are vastly higher than they were when Baxter acquired Hillrom, carrying a massive debt load is an existential threat.
Because of the interest payments.
Right. High leverage means your operating profits are entirely consumed by interest payments to bondholders. Driving leverage down to 3x is the universally recognized threshold for a stable investment-grade balance sheet in the medical device sector.
So they're getting back to safety.
Exactly. By relentlessly focusing on cash generation and debt reduction, management is systematically de-risking the entire company.
They are removing the sword of Damocles.
That's it. And as CEO Hyder pointed out, repairing the balance sheet unlocks strategic optionality down the line.
Meaning they can start playing offense again.
Exactly. Once you are no longer chained to massive interest payments, you can redirect that cash flow into high-margin tuck-in acquisitions to grow the business, or you can return capital directly to shareholders through stock repurchases and dividends. But you must earn the right to play offense by fixing the defense first.
Makes total sense. Okay, let's distill all of this into a clear, actionable framework. If an investor holds BAX in their portfolio today, or they're evaluating it as a deep value turnaround play, what is the core thesis they need to monitor?
The investment thesis relies entirely on the successful intersection of 2 trends: relentless quarter-over-quarter debt reduction and the realization of Q3 margin expansion.
So it's not a flashy play.
No, you are not buying a hypergrowth tech stock here. You are buying into a methodical industrial grind.
Which means the upcoming Q3 earnings report is the ultimate litmus test.
It is the crucible. Investors must scrutinize the Q3 operating margins with 0 tolerance for excuses.
No more ghosts.
Exactly. Management has explicitly promised that the expensive 2025 inventory is gone and the cost-cutting measures are taking effect. If Q3 margins remain flat, or worse, if they contract again, the entire turnaround narrative fractures. The ghost of 2025 is dead. They can no longer blame the past.
They are totally out of alibis. Watch the Q3 margins. If they don't expand, the thesis breaks. That's a very concrete, actionable takeaway. But before we wrap up today, we have to address the wild card.
There's always a wild card.
There is. Throughout this analysis, we have focused heavily on financial engineering, accounting rules, and factory overhead. But Baxter is fundamentally a medical technology company. They survive by selling cutting-edge equipment to hospitals.
Which is incredibly hard to do.
It is. And there's a massive product-level risk hovering over this stock that the financial metrics just don't fully capture yet.
You are referring to the regulatory quagmire surrounding the Novum IQ LVP.
Yes, the Novum IQ large volume pump.
Yeah.
This is not just another product. This is supposed to be the technological crown jewel of their infusion systems division.
It's their future.
Exactly. It is the next generation platform designed to secure their market share for the next decade. And right now, it is completely paralyzed.
Yeah, it is currently locked down under a regulatory shipment and installation hold. They literally cannot put these machines into hospitals.
And management attempted to thread the needle on this issue during the call. They stated they're in the, quote, early stages of verification testing to resolve the software or hardware issues, and they are communicating with regulatory authorities.
Standard corporate PR.
Right. They also heavily leaned on the narrative that demand for their older legacy platform, the Spectrum IQ pump, remains incredibly robust, essentially arguing that the delay isn't hurting their current sales. But I want to challenge that assumption because in the hyper-competitive, high-stakes ecosystem of hospital IT, patience is virtually non-existent.
Oh, absolutely. The switching costs in this industry are astronomical. A hospital network doesn't just buy a few IV pumps,
Right.
They integrate an entire fleet of thousands of pumps into their central electronic health record system like Epic or Cerner.
It's a massive project.
It requires immense capital expenditure, huge IT cybersecurity integration, and literally hundreds of hours of retraining for the nursing staff.
Exactly. It is a monumental undertaking.
Yeah.
So imagine you are a hospital administrator whose current fleet of pumps is aging out. You want to upgrade to the latest technology. Baxter tells you their shiny new Novum pump is stuck in regulatory purgatory indefinitely.
You start looking elsewhere.
Exactly. How long do you wait before you pick up the phone and call their fiercest competitors like BD or ICU Medical?
You don't wait long. The risk of market share erosion is severe here, because if a hospital network decides they cannot wait and they transition to a competitor's platform, Baxter doesn't just lose a single sale.
No.
They lose that entire hospital system's recurring revenue for the next 7 to 10 years.
It is the classic razor and blades model. If you lose the pump contract, you lose the ongoing sales of all the proprietary IV tubing and software subscriptions that go with it.
It's devastating to lose a contract like that.
Right. So if that regulatory hold drags late into 2026 or bleeds into 2027, the supposed steady demand for their older legacy pumps will absolutely begin to crack. And if they start losing core market share in their infusion division, all the factory cost cutting and debt reduction in the world will not save the top line from collapsing.
It's a race against the clock. Management must clear those regulatory hurdles and unleash the Novum IQ before the market loses faith. It is the ultimate operational test of this turnaround.
It really is the ultimate test. And, it brings us full circle to how we started this deep dive.
The X-ray analogy.
Exactly. We look for clean, binary X-rays in corporate finance. But what we usually find is this chaotic MRI requiring intense, methodical analysis.
There are no easy answers.
Nope. But we have waded through the diagnostic muddy waters of Baxter today. We have isolated that $75 million tariff anomaly, dissected the margin pressures of drug compounding, explained the delayed destruction caused by inventory absorption accounting.
Which is a mouthful, just to say.
It is. And we weighed the critical importance of a 3x leverage target against the looming threat of that product regulatory hold.
It is a fragile, but frankly fascinating corporate ecosystem.
It truly is. Hopefully, by stripping away the jargon and looking at the actual mechanics driving the numbers, we've equipped you to read this specific MRI with much more clarity.
Keep your eyes on the data.
Always keep a microscopic focus on those Q3 margins to see if the cost cutting is real. Watch the regulatory wire for any updates on the Novum IQ pump and evaluate your position based on the mechanics, not the headlines. Thank you for joining us on this Rigorous Talk Tickers deep dive. We will see you next time.